Is Canoo implementing a genius strategy? That's the question I want to address in this short video here. So let's dive right into it. And the strategy I'm talking about is Canoo saying that they will only build what we have sold. They will only build what we have sold. In other words, when they're considering manufacturing vehicles, they're only going to manufacture those vehicles that someone has already paid for, that someone has already purchased. So they don't run the risk of building a vehicle and having it sit around without someone to send it to. Now, is that a genius strategy? It could be. It could be. One of the benefits of that strategy is that it allows the company to more effectively use its capital so that it's not spending money to build a vehicle and then that money is sitting in a parking lot somewhere, not getting sold to somebody. So that's money that's just sitting around, not earning any return on investment. So if Canoo only makes the vehicle that has someone purchased already, then it just goes directly to that purchaser, and Canoo can go about making another vehicle using those resources to purchase more materials to make more vehicles, and thereby enhancing the speed at which cash turns into sales and not sitting around in parking lots. So that's an interesting strategy. However, the downside of that strategy is what happens if you don't have orders. What happens right now? Of course, Canoo is just ramping up production, right? So right now it has a backlog. In fact, they have 18,000 units of committed orders, and they're focusing on customers for 2024 and 2025 deliveries. So for the rest of this year, they've already got customer allocations figured out. But what happens if they get to a point where they don't have sales and their manufacturing facilities are sitting idle? That's the downside. Is you've got this manufacturing facility, you've got the overhead of running this manufacturing facility. Whether you produce units or not, you're going to have to pay for upkeep, a certain amount of labor, and so you're not producing anything, and thereby you're just losing money waiting for a customer order to come in so that you can produce something. So there is a downside to that strategy that's not yet evident and won't be evident for some time, because the company does have so much backlog, so much inventory that it has sold ahead of time, right? And so Canoo is implementing a combination of in-house, hybrid, and outsourced to support their 20,000 vehicle run rate. And so this strategy could also limit the speed at which they ramp up, because they're waiting to secure enough orders, and then they're going to spend capital investment to increase manufacturing capacity. So it is definitely a lower risk strategy, but it does have downsides. It does have the risk of not ramping up quickly enough, having your facilities run idle. The running idle part, not a concern for Canoo right now, but maybe 2 years down the line, 3 years down the line, it could be, and at which point they might change this strategy. This strategy doesn't have to be set in stone where they say we're only going to build what we have sold. That's what they're deciding right now. But, 3 years later, if the situation changes, they could change that strategy. So it also allows them some flexibility to change the strategy if need be. But for now, I think it's prudent to run the business in this way, because the cost of capital has increased so much and you want to reduce your capital spending, your capital intensity, and this is a good way to do that. All right, so interesting strategy decision for Canoo and for Canoo stock investors. But that's it for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.